All right. Good evening, everybody. And we are starting the class right now. And tonight we'll be looking at introduction to forex trading. Of course, that's the same as forex basics. So let's get straight to business. Um, in this particular lesson, we'll be looking at before the basics, history of forex, what is forex, merits of forex trading versus stocks, how is forex traded, governments and central banks, financial institutions and commercial banks, market makers, smart money, and retail traders. Those are people who are involved in the forex market. Then after that, we look at forex terminologies, and then we look at trading sessions or market hours. Then we learn how you read forex codes. That's we look at the major currencies traded in forex. We look at the base and the quote currency. We look at the eight major currency pairs, and we look at the currency cross. And then we also look at how you place forex orders in the forex market. The different kind of orders we have: the instant execution, the pending orders, the stop loss, the take profit, and the target price. And afterwards, we look at forex charts, the different kind of charts we have, the three basic different charts: line chart, bar chart, and candlestick charts. And then we look at the Japanese candlestick and some candlestick pattern. And finally, we would end the class with fundamental analysis. So let's shoot and let's get it running. So before the basics, let's face the reality of forex trading. Just like any other business, you go into business to make profit. Just like every other business you do, you go into business to make profit. So also in forex, there is money in forex, but then there is a reality everybody is ignoring. And the reality is that as much as there is money in this business, you can actually run into losses as well, just like any other business. There are days where you run into losses. There are days where you make reasonable profit, and there are days where you make mind-blowing profit as well. But then you need to understand that when you're coming into this business, you are coming to learn. That's reality. The reality is, if you are here to learn, you will make the money. But if you are here just for the sake of the money, you may eventually not make the money on the long run. So I want you to ask yourself some questions. Are you here to gamble, or do you mean business? Are you here to gamble away, or do you actually mean business when you are coming into this business? Are you here just to guess, to give it a try, to give it a shot? Or are you here to stick to it? Are you here to stick to the business? Are you here to go through the storm that might come in this business? Are you here to stick to it, to learn the basics, to grow and to become better in this business? Do you have what it takes to be successful in this industry? Do you have the commitment, dedication? Do you have the zeal? Do you have the passion? Do you have the necessary attitude to be successful in this business? And you need to answer these questions, because if you feel you can just come into this business and just come inside, make money, and maybe after a few months you're already sitting on millions of dollars, that is a big fat lie. And that is a big fat lie, I repeat, because you can't just come into this game and in a few months you're claiming that you're already making millions of dollars. How did you do it? You have to go through the basics. You have to go through the learning process. Even if you gamble and if luck smiles on you, you make millions of dollars in one single trade. What is the probability that you can sustain that profit? So why don't you just focus on the process? You learn the process, you grow with the process, so that when you are managing something bigger, you would have what it takes to sustain it. Now, there is this common saying in the business that 90% people that come into the trading business lose their money and only 10% win. The question is, why do 90% lose, and why do we have only 10% that are winning? It's very simple. The answer is just that out of 100 persons that come into the business, about 10 are ready to learn, while the other 90 just want to make money. So if you want to just make money, you will keep losing until you understand that it's not about making money. It's about learning. It's about growing. So that's the reason why 90% lose. 90% lose because they just want to come into the business and just make They want to get rich quick, and it doesn't work that way. Only 10% out of those who join the business, only 10% of them or less are the ones who are ready to learn, are the ones who are ready to stick to the horror, are the ones who are ready to weather the storm, are the ones who are ready to give it all it takes just to make sure that they are getting better. And please, once you start learning, you don't stop learning, because the moment you stop learning, your earnings start going down. You keep learning every single day, every single week, every single month, every single year. You keep learning, you keep getting better. When you stop learning, you stop earning. That is just it. When you stop learning, you stop earning. Now, a guy was asked one time that how did he do it that he became a millionaire overnight, and he gave them a simple answer. He said that night was the longest night in history. And what that simply meant was that it took him years before he could achieve that status of overnight millionaire. So there is no such thing as literally someone became a millionaire overnight. It does not work that way. There is no such thing as an overnight millionaire. So just forget, zero your mind, and don't come into this business with the idea that you want to start trading today and then tomorrow you buy G-Wagon. It doesn't work that way. This is a place to learn. This is a place where you grow your business. This is a place where your business grow as you are growing. So your business would not grow more than you grow. Now, I've been trading for over a year right now, and it took me almost 6 months before I really understood what it takes to be a trader. When I started trading, all I wanted was just to make money. Like most of you also, when you start trading, you just want to make the money. And maybe the first month, when you are still trading on demo accounts, you make profit on demo account, you feel you are good to go. And then you start live trading. And then the first week, the second week, the third week, you're making profit on demo. And then you start a live account. Then your first trade on live account starts running a loss. And before you know it, your account is gone. It took me time to understand that losses is part of the game. Losses are part of the game. It took me a while to understand that. And you need to understand it as early as possible so that you can save yourself a lot of mental stress. If you understand as early as possible that when you start trading, losses are part of the game, your main goal is to cut your losses and maximize your profit. So don't come into the game that it is all about the profit. It is not all about the profit. It is all about the learning. It is all about your growth. It is all about your personal development, your self-growth. It is all about how willing and ready are you to learn before you can actually make something significant out of this game. You might have heard of a lot of people who have been trading and making quite some profit from it. You have heard of Sandy Leshezi, Warren Buffett, George Soros, Robert Kiyosaki. All those guys, they are all encouraging forex trading because they understand the potential that lies in forex trading. They know that there is huge potential in this business, so they understand that you can make a lot of money from the business. They understand that there is a lot of potential in this game, and they have gone through the process of learning. They have gone through the process of self-development. They understand how the entire thing works, and they are also encouraging you to learn so that you can also earn. Now let's go through a brief history of the forex market. The forex market, the money came into being in such a way that it was okay. Everything started through the barter system. The barter system is when you want to get something, then you have to give something in exchange for something. So if you want to get a cloth, you need to look for somebody who is ready to give a cloth in exchange for what you have. So if what you have is a pair of shoe, you have to look for somebody who needs a pair of shoe to exchange for that person's shirt or clothes. So that is simply the barter system. For example, you go to the market, you have a bowl of rice, and you need a tuber of yam. You need to look for somebody who needs your bowl of rice before you can get that tuber of yam, and the person must also be willing and ready to give a tuber of yam. So that was how the barter system worked. And there was this problem of measuring the value of what you're exchanging, in the sense that, how do I know that for example, I want to exchange my pair of shoe for your shirt. How do I know that my pair of shoe is not more valuable than your shirt? How do I know that your shirt is not more valuable than my pair of shoe? So there was this challenge or this problem of measuring the value of what you're exchanging for. So there was a need for a universally accepted currency or money. And in those days, they use metal as currencies. They use metal as money. So the heavier your metal, the more valuable your metal is. And that's why gold and silver are the true money. They were the true money, and they are still the true money till date. Gold and silver. In those days, they were using copper. They were using copper. A lot of precious metals, cowries, a lot of precious metals. So the heavier your metal is, the more valuable your money is. So instead of exchanging your good for another good, you take your money, you measure the value of what you need, you take the commensurate value of that particular of the money you have, you give it to the person, you get the good. So there was no need for me to be walking around looking for somebody who needs my pair of shoe to get their shirt. So all I need is to just go to the market with my money, and I will buy whatever I need. So that was how money came into play. And Forex started about 500 years ago. That was when a lot of business guys would come together from, after a lot of business expenditures, they would come around together, sit under the tree, discuss their trades, and exchange the money with them. And they were just trading currencies freely, just to stabilize the exchange rate. And gold and silver were actually the true money. And there was the gold standard in 1875. That means a country's wealth is measured by how much of gold they have in their reserve. A country's wealth is measured by how much of gold they have in their reserve. So your reserve right now in the current economy of the world, it is how much US dollars you have in your reserve that determines how wealthy your nation is. And before the US dollar became the standard, the gold was the standard. The gold was the standard. And it was at the end of World War One and World War Two that brought an end to the gold standard. That was when countries wanted to get some ammunition for themselves, and they were having issues using gold as a standard. So they decided that they should use the US dollar as they decided to use the US dollar as a basis for all their currencies. And the US dollar is a property of the government. There is a difference between currency and money. Money is something that appreciates in value, but the currency can actually depreciate in value. The currency is a property of the government, not your own property. That means the money sitting in your pocket right now is not your property. It's the property of the federal government. The federal government can decide the value the money you have in your wallet would carry. So they can decide that one US dollar would worth 500 naira, for example. The federal government of Nigeria, for example, can decide that one US dollar would equal to 500 naira, or one US dollar would equal to 100 naira. So it depends on whatever the federal government wants to do. It is the property of the federal government, so they can do whatever they want to do with it. And that is why the value of currencies in the world today keeps going down, while the value of money, gold and silver, keeps going up. If you check through history, gold has been appreciating over the time. Right now, 1 ounce of gold is about $1,200. $1,200 per ounce. 1 ounce of gold is about $1,200. And one US dollar compared to your country's currency would keep varying, would keep floating. The same thing with the value of gold. But one thing is certain about gold, and that is the fact that if you invest in gold, it is a long-term investment that would definitely pay great reward. And that is why Robert Kiyosaki said something that I would never forget. Said, the true money today is gold. So it is those who have gold that really have the money. So that is a brief history. Forex became widely electronic around the mid-1990s. So Forex has been on since then until now. We still have Forex. The difference is that right now, Forex is now more electronic than in those days. In those days, you have to call your broker over the phone, and then they have to put your order manually. And that would take a lot of time, creating a lot of arbitrages. But now that everything is electronic, you can do it real-time basis. You can pick your trade in seconds, in minutes, and everything is executed already. Now let us do a brief comparison between stock and forex. The stock market has more popularity than the forex market. The stock market has more popularity than the forex market. The forex market is the largest and ever expanding financial market in the world, with about $6 trillion traded every day, while the stock market is just about $30 billion in size. So you can see the huge difference. You can see the huge difference in that. The forex market is the largest and it is still expanding because the forex market will keep existing as long as we have countries all over the world. As long as you have countries all over the world. While the stock market is just about $30 billion in size. $30 billion inside. That's a lot, multiple folds of the stock market. The forex market is always open 24 hours Monday to Friday with the ability to customize your trading schedule. That means that you can actually decide to sit with your laptop 24 hours Monday to Friday and keep trading non-stop. Or you can decide that you want to trade only in the morning, or you can decide to trade only in the afternoon or only at night. So the market is open 24 hours, Monday to Friday, 24 hours for 5 days. That's when the market is open. And no commission is charged. Your brokers are compensated through spread. However, some brokers actually deduct commission when you want to make withdrawals from their accounts. So like my broker, for example, whenever I want to make a withdrawal, they will deduct I think 1% or 1.5% of the amount I am withdrawing. So, and the reason why I'm still using them despite their commission is because I can get my withdrawal within 24 hours, within 24 hours, within 24 hours. So sorry. So cost of trading forex is low compared to stocks. The cost of trading forex is very, very low compared to stocks. If you want to trade stocks, you need a lot of capital. You need a lot of capital. You need because stocks is more of a long-term investment. So when you're investing in stocks, you need a lot of huge capital to make significant or reasonable profits. However, in forex, you can start with a very small capital and grow it over time. Within a short period of time, you can grow your capital. That's because it is basically because of the volatility. It's basically because of the volatility. So it's basically because of the volatility. The forex market is more volatile than the stock market, and we have instant execution of orders. We have instant executions of orders, unlike the stock market where you have to first of all get a broker. Then after you've gotten a broker, you first of all fill some forms, and then after you filled some forms, you need to start following up a lot of legal processes and all that. So by the time you are through with all that and you want to start placing your orders, you still need to call your broker and know what's up. But with forex, you can do your orders, you can execute your orders instantly, and no restrictions on short selling. That means you don't have to, in the stock market, you have to buy a stock before you can sell a stock. However, in the forex market, you don't have to buy a currency before you sell that currency. You can actually buy a currency without first of all um selling without you can sell a currency without first of all buying the currency. And there is no intermediaries between you and the market. There are quicker access to the market at a cheaper cost. No intermediaries between you and the market. There are quicker access to the market at a cheaper rate. No single individual can control the market for buys and sells. Stocks is very susceptible to large fund buying and selling. That means that in stock market, one person can actually control what happens in the market, in the stock market. If you are part of the board or director of a particular company, you can decide how the stock is functioning, if it is doing fine or not. But in the forex market, no single individual can do that. The forex market. No single individual can do that in the forex market. And analysts and brokers are less likely to influence the market. Analysts and brokers are less likely. The chances that they would control, they would influence the market are unlikely. Thousands of shares versus 8 major currency pairs. In the stock market, we have thousands of shares. So it is going to be difficult to know which kind of shares you want to pick. It is going to be difficult to know which of the shares would do fine out of thousands of shares. But in the forex market, you can just focus on we have just 8 major currency pairs. in the entire forex market. We have just 8 major currency pairs in the entire forex market. So you can focus on the 8 major currency pairs while you decide to maybe look for some other exotic or currency crosses. And there is guaranteed of limited risk in the forex market. The price is known, and the forex market operates at a higher volume, which will offer you a better liquidity. Which will offer you a better liquidity. Which will offer you a better liquidity. So the forex market is a place to make fast money. It is also a place to lose all your money in a twinkle of an eye. The forex market is a place to make fast money, and it's also a place to lose all your money in a twinkle of an eye. I think that is straightforward already. I think that is straightforward. You just have to get it right. Treat it like a business. If you are going to build wealth in this industry, don't treat it like a gamble. I am emphasizing this. Don't treat it like a gamble. Treat it like a business. Grow it like a business. Treat it like a normal business. Let it grow like a normal business. And don't forget that you have to keep learning. The more you learn, the more you earn. The more you learn, the more you earn. The more you learn, the more you earn. So, the government and the central banks, these are just the major markets. These are the major markets participants in the forex market. These are the major forex market participants. We have the government and the central banks. We have the large financial institutions. We have the market makers and the smart money or the brokers. And we have the retail traders. The retail traders are always the ones with 5%. The retail traders are the ones with 5%. The government and central banks takes 25%, takes 50% rather. Large financial institutions take 25%. Market makers, brokers take 20%, and retail traders take 5%. We are the retail traders. You and I are the retail traders. So we have the lowest percentage in the entire forex market. So it's they don't really care about what happens to you in the entire forex market. They don't care about what happens to you in the forex market. They don't care about what happens in the forex market. So we carry the lowest percentage. Now, how is forex traded? These are the top 10 forex market participants. These are the top 10 forex market participants. These are just for statistical basis. You don't really need all these for your success. These are just for knowledge sake. So this is the hierarchy. The major banks are ahead, then followed by the electronic broking services, followed by medium-sized and small banks. Then we have the retail market makers, retail ECNs, hedge funds and commercial companies, and then we have retail traders. So those are the hierarchy. You can just know that for knowing sake. Now let's look at the terminologies in forex trading. The terminologies in forex trading. We have long and short. We have long and short. We have long and short. Now, long simply means buy. So when you hear somebody says, I'm going long on a particular currency, what they are saying is I am buying that currency. If someone says I am going short on a particular currency, what he's saying is I am selling a particular currency. So long means I'm buying, and it is also the same as bull. So if you hear someone saying something like excuse me, if you hear somebody saying something like I am bullish on a particular pair, what they are saying is I am buying a particular pair, or I am going long. That means I am buying the same thing. You can also use north. I am going north, or you can say that pair is looking dovish. Dovish, D-O-V-I-S-H, dove, from dove, dovish. So those are the 4 or 5 terminologies that simply means buy. Now for short means you are selling. It's also the same as bearish, and you can also say hawkish, hawk, H-A-W-K, hawkish, and you can also say you are going south. So those are the terminologies you use in the forex market. Now we have the bid and ask price. We have the bid and ask price. Now the bid price is the price a buyer is willing to buy. The bid price is the price a buyer is willing to pay to buy a particular currency, and it is always on the left, and it is lower. It is the lower price. It is always on the left, and it's the lower price. The bid price is the price the buyer is willing to pay. Always on the right, and it is the lower price. I'm going to show us how that looks like on a live chart. The ask price is the price a seller is willing to sell, and it is always on the right, and it's the higher price. The ask price is the price a seller is willing to sell, always on the right, and it is a higher price. While the spread is the difference between the asking price and the bidding price. That is the spread. The spread is simply the difference between the asking price and the bidding price. So let me share an example. Let me share an example with us. Let me share an example with us. Now, this is my live chat. This is my live chat here. You can see the currency pairs right here. You can see the currency pairs right here. So we have the USD CHF. You can see the bid price here, and you can see the ask price on the right. You can see the bid on the left. You can see the ask on the right. You can see the prices are constantly changing. That is simply to tell you that the market is active, and it has been active since yesterday, Sunday. The market opens Sunday by 11 p.m. This period, 11 p.m., and it will close on Friday by 11 p.m. as well. So from now till Friday, this will keep changing. The prices will keep changing. So you can see this is the bid price and this is the ask price. I can't say this is the bid price for this because it is constantly changing. But just know that the bid price is always on the left and the ask price is always on the right. And I don't think you really need to focus too much on that. You don't need to start calculating the bid price or calculating the ask price. It is automated. It is bringing it out automatically for you. And you also don't need to sit down and be calculating your spread. It is not necessary. It is not really necessary for you to be calculating your spread, except you are very, 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 very keen about how much your broker is making. And that would give you a lot of headaches and a lot of stress. So that is the bid and the ask price. Now, the difference between the bid and the ask price is simply the difference between the bid and the ask price is simply the spread. So if you want to know the spread, just know that it's the difference between the bid and the ask price. So let's go back to where we were before. All right, so now pips and points. Pips and points. Pips is simply how far a currency moves. How far a currency moves. And points is just pips times 10. That's if you have 45 pips, that'll be 450 points. So if you have 45 pips, that'll be 450 points. Now let me explain pips and points using using a live chart. Pips and points using a live chart. Okay. I want to explain pips and points using a live chart. Okay, here we are. All right, so now look at this chart here. Look at the Euro USD chart. Now, to calculate your pips, let's say this is today's candle. I'm going to teach candlestick very shortly, but I want to explain pips and points very briefly. I want to explain pips and points very briefly. So today's charts only moved from here to here. Let me expand it very well. Moved from here to here. Now from here, this is 1.144. 1.1440. I want to explain pips and points. This is 1.144, and this is where it is currently. It is currently at 1.136. 1.136. 1.1360. Now, to calculate how many pips this has moved, for us to know how far this has moved, we start talking about pips. Now, to calculate how many pips this has moved, all we need to do is simply subtract the lower price from the higher price. So that would be 1.1440 minus 1.1360, and that is equals to 0.0040. Now, when you subtract 1.1440, which is the higher price, when you subtract the lower price, 1.1360, from the higher price, which is 1.1440, you have 0.0040. Now, how does this now convert to pips? A pip is the fourth decimal, a fourth decimal, the fourth decimal. The fourth decimal. That's why we have this in 4 decimal places. The fourth decimal. So that simply means that this 0.440 in essence means 40 pips. In essence means 40 pips. So after you've calculated the difference and you have 0.004, that simply means you have 40 pips. The last two to the fourth decimal. The last two to the fourth decimal. Let's assume that after you've subtracted the lower price from the higher price, you have something like 0.000005. This is the same as 5 pips. Let's assume that after you subtracted the lower price from the higher price, you have 0.0050. This is the same as 50 pips. Let's assume that after you've subtracted the lower price from the higher price, you have 0.05000. That's the same as 500 pips. So that's how you do the calculation of pips. You subtract the lower price from the higher price, and then you look at it to the fourth decimal. The fourth decimal here is 5. That's why we have 5 pips. The fourth decimal here is 0. But before that 0, you have 5. That's why you have 50 pips. The fourth decimal here is 0.1440. Sorry, that will give you 0.008, not 4. 0.008. And that would be 80 pips. That will be 80 pips. That will be 80 pips. So that will be 80 pips. Now, all you need to do when you are calculating your pips is to simply subtract the lower price from the higher price. Once you've subtracted the lower price from the higher price, the fourth decimal place is the number of pips you have in that particular currency. So that's what I'm trying to explain in this area. Here you have the fourth decimal, which is 4. That's you have 4, but you have some brokers would give you in 5 decimal places. Some brokers will give you in 5 decimal places, while some broker will give you in 4 decimal places. Some brokers will give you in 5 decimal places. Some brokers will give you in 4 decimal places. But what you need is a 4th decimal place. So if your broker is giving you in 5 decimal places, the 5th one is just a minute. Is minute. You can ignore it. Actually, that's what I'm trying to say. You can ignore it. So that is that about that. And you also have to note that for JPY pairs, JPY is Japanese yen. For JPY pairs, you don't have it in 4 decimal places. You have it in 2 decimal places. You have it in 2 decimal places. But you can also have it in 3 decimal places. So for JPY pairs, the 3rd decimal place is insignificant or minute, but you need just the 2nd decimal place or the 4th decimal place for normal currency pairs apart from JPY pairs. Now, we are still on forex terminologies. I want to look at lot and position size. Lot and position size. Lot and position size are simply contracts that are of different sizes. We have 4 lot sizes in forex trading. We have the standard lot, we have the mini lot, we have the micro lot, and we have the nano lot. We have the standard lot, which is the highest. We have the mini lot, which is the 2nd. We have the micro, which is the 3rd, and we have the nano, which is the 4th. And most of the time, people don't use the nano lot size. Each of them have their units. For the standard lot size, it is 100,000 units, and the volume is 1.00. And what this simply means is that for every single pip that your trade is doing, for a standard lot, you are earning $10 per pip. You are either earning or losing $10 per pip. So, for example, the example we used earlier, that we calculated 80 pips. If you are using a standard lot, that would have been 80 pips times $10. That would have been $800 for 80 pips. Now, for a mini lot size is 10,000 units, and that's 0.10 volume. And the profit or loss here is simply $1 per pip. So for that 80 pips, if you are using a standard lot for 80 pips, you are making $800. But if you are using a mini lot size for 80 pips, you are making $80. So you can see the difference. For a micro lot, The unit is 1,000 units and the volume is 0.01, and the profit or loss is 10 cents per pip. 10 cents per pip. So for that same 80 pips where you make for a standard lot using when you make 80 pips on a particular trade and you use a standard lot, you are making $800. If you use a mini lot, you are making $8. If you use a micro lot, you are making I'm sorry, if you use a standard lot, you're making $800. If you use a mini lot, you're making $80. And if you use a micro lot, you're making $8. So you can see the difference. Now, if you're using a nano lot, this is the least and it is uncommon. People don't use the nano lot because it is so minute, except you are trading on a cent account. The nano lot is simply 100 units and 0.001, and that is 1 cent per pip. 1 cent per pip. That means for $80, for 80 pips, you would have made just that would have made just 8 cents. You'd have made just you'd have made just yeah, you would have made 80 cents. You'd have made 80 cents altogether. Now, this volume is what you impute in your MT4. Now, let me show you what that means. Let me take you to my live chart. Now, this is my live chart and my running trade. You can see this area. You can see this size here. You can see the type. I am selling Euro USD, and the size is 0.01. 0.01. Euro USD 0.01. Now, what this 0.01 means is that I am using a micro lot. I am using a micro lot. That's what that 0.01 is saying. If I had used 0.1, that would have been a mini lot. Let me show you another account of mine. Another account where I used a mini lot. Okay, so this is the account where I used a mini lot. I sold natural gas this morning and I used 0.1. That is a mini lot. That's a mini lot. So that is how you calculate, how you check for your lot size and your position size. So and the lot size you use depends on your account size. You don't use standard lot on every account. You don't use standard lot on every account. You don't. Your lot size depends on your account size. For example, if you are using an account that is around, let's say, $100 or lower, you shouldn't use more than a micro lot for that account. You shouldn't use more than a micro lot for that account. And if you have more than $100, let's say you have up to $500 or $1,000, you can decide to use a mini lot. You can decide to use a mini lot. And if you have more than $1,000, maybe like $5,000, $10,000, you can decide to use a standard lot. But for the sake of this class, I'm going to be restricting us to a micro lot because we are just starting. So I'm going to be limiting us to a micro lot to start from that, except we have one of us who would want to use a nano lot or a cent account that we're going to place on a nano lot. So that is that about lot and position size. So if you have any question, you can drop your questions on the group chat. I'll be attending to your question as the class is ongoing. So you can just type me your questions on the group chat. And I mean the Zoom group chat. You can type me. I'm going to drop it right now. You can drop your questions here. You should all get this message. You can drop your questions. Yeah. So if you have any question, just reply the message I just sent to the Zoom group chat. All right. So after lots and position size, we move to swap and rollover. This is simply a commission charged or paid into your account for opening a trade position for more than 24 hours. If you have a running trade and it is exceeding 24 hours, you are either charged or paid a commission into your trading account. It depends on the currency you are trading, depends on the currency pair you are trading, and it depends on the interest rate of that currency pair you are trading. So if you If you are holding a trade for more than 24 hours, you are either charged a commission or you are paid a commission into your trading account. Now, margin and leverage. Margin is simply a loan that your broker would extend to you to trade. Margin is a loan that will be extended by your broker to allow you to leverage, to take more trades. It is more like a loan that you don't pay interest on. So that is margin. We have margin of 1 to 1, you have margin of 1 to 200, 1 to 500, and 1 to 1000. What that simply means is that if you are using a margin requirement of 1 to 1, that means you are not using any leverage offered by your broker. You are simply using your account and your account alone. If you are using leverage of 1 to 1000, that means if you have a $100 account, that $100 account can trade up to $100,000 in the standard in the volume capacity. I mean, in the unit capacity, rather, in the unit capacity. Not that $100 would mean $100,000, no, but the capacity of that $100 would be almost the same as the capacity of a $100,000 account. We are using a 1 to 1000 leverage. So we have some other terminologies here. We have volatility, liquidity, and volume. Volatility is simply the amount of uncertainty or risk involved in trading. And let me tell you something, or let me give a disclaimer at this point. Trading is very risky. And the reason why it is very risky is because of the volatility. The forex market has high volatility, and this means there is a high amount of uncertainty, high amount of risk involved. And the good side of this is that when there is high volatility, that means that the exchange rates are fluctuating dramatically and the conditions in the market are changing rapidly. And this is the trader's paradise. This is where a trader can make a lot of money. And at the same time, don't forget the other side of the coin. It's also the place where a trader can lose a lot of money. When there is low volatility in the market, that means that the market is very sluggish and the movement is very slow. This is a trader's nightmare, because at this point, the market will be very sluggish and extremely slow, extremely slow. But if when we start talking about the different kind of traders, you realize that low volatility has its own benefits, and you can also do your calculations very well. That you, with high volatility, you can still be making significant profits. Liquidity is simply the number of participants in the market. How many participants we have in the market? As the year is coming to an end right now, the liquidity in the market is reducing. The number of participants in the market is going down, because people are already cashing out for the year, going on holidays and family vacation and all that. Volume is the size of the orders being placed in the market. Volume is simply the size of the orders that have been placed in the market. Now, trading sessions, we have 4 major trading sessions. We have the Sydney session, we have the Tokyo session, we have the London session, we have the New York session. Those are the 4 major trading sessions we have in the forex market. We have the Sydney session, we have the Tokyo session, we have the London session, we have the New York session. The Sydney and Tokyo session together are known as the Asian section. So if you want to know the time zone of your own particular area, just visit this link, forex.timezoneconverter.com. Let me copy it. Okay. I want to see if I can copy it. Okay. I will share the link on the group. So if you wish to convert to your own time zone. So let's go through the trading sessions, and most likely we might end the class for tonight there, or we'll see if you can still extend it further. All right, so the Sydney session is the major currency in the Sydney session is the Australian dollar and the New Zealand dollar. They are the major currencies for the Sydney session. The Australian dollar and the New Zealand dollar, they are the major currencies. And they are sometimes referred to as the Australian market. It is the smallest and the calmest in the entire market. It is the smallest and the calmest in the entire market. And that is where the forex market officially opens every single day. The forex market officially opens with the Sydney session every single day. The Tokyo session is embedded within the Sydney session. You can see the time differences. The Sydney sessions opens by 10 p.m., while the Tokyo sessions opens by 11 p.m. The Sydney session closes by 7 a.m., while the Turkey session closes by 8 a.m. So altogether, the Asian session is between 10 p.m. and 8 a.m. Altogether, the Asian session is between 10 p.m. and 8 a.m. I'm using Nigerian time. I'm using Nigerian time here. Now, the Tokyo session is known with higher spreads, and the Japanese yen is the major currency here. The Japanese yen is the third most traded currency in forex, and it takes 6% of the entire forex transaction. The London session is the biggest and the largest center of trading. That's where we have the pound, the euro, and the Swiss franc. And this session takes 34% of all the forex transactions. It is the most active trading session with high liquidity, high volume, and low spreads. So London session is more like the best place to trade. I'm not saying it is the best place. I said it is more like the best place to trade. It opens by 8 a.m., closes by 5 p.m. That's the London session. Opens by 8 a.m. and closes by 5 p.m. The New York session, that's where the market ends every day. The market ends with the New York session every day and takes 85% of the trade in the entire forex market takes place in the New York session. That's where we have the US dollar and the Canadian dollar. And once it is 6 p.m., volatility dies down. Once it is 6 p.m. And it is this session that we have a lot of news release. A lot of news are released around this session. And it opens by 1 p.m., closes by 10 p.m. And that's for the New York session. Now, the Forex codes, we have, these are the major currency pairs we have in the Forex market. We have the Euro USD, we take 28% of all the Forex transactions. We have the USD JPY, that's the US dollar Japanese yen, 14%. We have the pound US dollar, 9%. We have the Australian dollar, US dollar, also known as the Aussie, that's the 6%. We have the USD and the Canadian dollar takes 5%. We have the USD and the Swiss franc takes 4%. We have the euro and the Japanese yen takes 3%, and the euro pound also takes 3%. So if you see any currency pair written like this, euro USD, the first currency by your left, towards your left, is simply the base currency. The base currency, while the one at your right is the quote currency. The one by your left is the base currency. The one by your right is the quote currency. The one by your left is the one by your left, this Euro USD, is the base currency, while the Euro is the base currency. The USD is the quote currency. So I'll be explaining that further later. This is simply the composition of the world forex reserves. The USD takes 62% of the entire world forex reserves. The pound takes 4%. The Japanese yen takes 4%. The euro takes 2%. Other currencies takes 28%. So the US dollar is more like the world standard, So that is why it is taking the highest proportion of that. The Euro USD is a widely traded currency pair. I've already mentioned that. And when you see something like Euro USD, I've already explained that the one by your left is the base currency. The one by your right is the quote currency. What that simply means is that when you have Euro USD equals to 1.11870, it simply means that 1 euro is exchanged for 1.187 US dollars. 1 euro is exchanged for 1.187 US dollars. That's what that simply means. That's what that simply means. So generally, the base currency is always on the left and the quote currency is always on the right. So I would like to end the class at this point. So tomorrow we will pick it up from here and round off on the introduction to Forex. So I would like to end the class right now. Then we'll pick it up from tomorrow. And if you have questions, you can just post your question on the Telegram group and let's discuss it and let's see how we can make this Zoom call better. Have a great night.